Let us consider the essential features of bond funds. I want to highlight the key features, the key characteristics of bond funds. Number one is fixed income focus. Fixed income focus. Bond funds aim to generate regular income from investors uh, through interest payments from the bonds in their portfolios. These funds essentially hold a portfolio of bonds, and these component bonds generates coupons, interest. So it's a fixed income focused kind of investments. Number two is diversification. These funds invest in a range of bonds across different issuers, across different sectors with a variety of maturity dates. And by so doing, there's that reduction in the risk exposure compared to even you are buying an individual bond from a single issuer. So you've been able to mitigate your risk, and as a result, so there's an adequate diversification in this context. Number three is credit quality. That's credit quality. So you discover that bond funds have they have that different level of credit risk depending on the quality of the bond. In other words, depending on the credit worthiness of the issuer of the bond. They may include investment grade bonds. These are issued by high, credit rated, high credit rated companies. Or you may have the high yield bond, the junk bonds with greater risk because the issuers are kind of considered financially unstable. So investment grade bonds are issued by credible, highly rated companies, issuers, while the junk bonds are issued by riskier companies, though they possess higher returns anyway. Number four is interest rate sensitivity. Bond funds prices are inversely related to interest rate changes. In other words, when interest rates fall, the bond prices will rise, and vice versa. So rising interest rate typically reduces bond prices and the fund net asset value, while falling interest rates automatically increases the net asset value of the bond fund. Number five is a maturity profile. Maturity profile. Bond funds can have a short term, a medium term, or a long term maturity period, affecting their risk as well as their returns. You may have some bonds, could mature in maybe 2 years, and some could take as long as 30, 40 years. So this duration tends to affect the interest rate as well as the risk profile of the bonds in question. Number six is regular income. Regular income. Bond funds often distribute, income regularly. It might be monthly, it might be quarterly, and it could be, annually. Making them attractive for income-focused investors, those who prioritize income over capital appreciation, then could invest in bond funds. Number 7 is on liquidity. Bond funds are generally liquid, allowing investors to buy or sell units on any trading day at the prevailing net asset value of the bond. So these bonds are tradable. They are traded in the market, in the open market. You want to buy, you could buy, and then you want to sell, you can equally sell at the prevailing market rate. Number 8 is a management style. Management style here, these funds are actively managed. It involves portfolio adjustment by fund managers to optimize returns. The portfolio is regularly they have this regularly. They balance the constituent bonds regularly in the portfolio so as to be able to achieve their stated objectives. And number 9 is expense ratio. Expense and ratios. Bond funds charge optimized returns. They charge optimized returns, and not only that, they tend to also take into consideration the very fact that these funds are actively managed quite all right, okay, and they need to charge a kind of fees on it, and these fees they are charging will then invariably eat into your returns at the end of the day, okay. So the activity incurred in the fund will attract kind of costs, the fund manager's fees, the research, the analysis they carry out and all those things will attract fees. And so we need to take into consideration. And the fund could be, most of the times they're actively managed, taken care of by the fund managers. They optimize the portfolio to be able to get the level of returns they so desire. Number 10 is tax treatment. Tax treatment. So interest income and capital gains from bond funds are often subject to taxation, although some government bonds funds may, provides that tax benefit. But generally, these funds are taxed by the government. But in some cases, there could be a level of tax exemption. Number 11 is risk factors. Risk factors. Bond funds carry credit risk. That's an issuer's default. The interest rate risk. That's a fluctuation in interest rates, as well as inflation risk. So the return may not really keep up with inflation. So these are the cardinal category of risk we should consider when it comes to investing in bonds. As interest rate fluctuates, as interest rate risk, it will affect the value of bonds inversely, the par value of bonds inversely, even the return on bonds inversely. And also inflation may equally eat into whatever returns you are getting. It will affect the buying power of the interest, the coupon you're collecting from the funds. And it's also that risk of default. The issuer may default on payments, may not be able to pay, maybe due to bankruptcy or whatever, may not be able to meet up with the payment obligations. Number 12 is stability. Bond funds generally offer lower risk and more predictable returns compared to equity funds. Not only that, it makes them more suitable for conservative investors or those seeking, portfolio stability. The returns actually, are low, but they are not as risky as, a typical equity fund. So it all boils down to a risk tolerance, your investment objective, as well as your, time horizon.